I'm Brendan. I'm a research analyst here at IMA, and we've got Vitaliy Katsenelson. Vitaliy, I've got a nice list of people on the webinar. I think what we're going to do is we're going to start with some questions. So basically, a big picture, I just want to say welcome everybody. So we are doing this experiment to, have Vitaliy engage with students in particular, and just kind of the community, the investment community in general during this, challenging time. Vitaliy, is there anything you want to say to kick off the meeting?
Yeah, every year, maybe 4 or 6 times a year, I would do a Q&A talk at DU, and I think there are a lot of DU students now on this webinar, or whatever you want to call this, and I really enjoyed it. And obviously, because of the coronavirus, that opportunity kind of vanished, but I really enjoyed doing it, and we realized we can do this for a much larger community now than just students at Denver University. And the reason I like to do it for students because I feel like older folks usually want to know, like they want me to give them a fish, whereas students want me to teach them how to fish, and I think I enjoy that a lot more than just giving fish to other people. So everybody who's on this call, thank you so much for joining us. I'm really glad you're here, and I'm looking forward to answering your questions. So.
Good. We've got a bunch of people on the call, but I think we have our first question from Mate Gombis. Mate, can you hear us?
Yep.
Oh, you can. Good. Okay, so Mate, do you want to just introduce yourself and sort of just tell us quickly about a little bit about yourself and go ahead and ask your question?
Sure. Thanks very much. So it might be surprising, but I'm actually joining you from Hungary, far from the US.
Welcome.
Thanks. Yeah, so I've been involved with investments for 3 or 4 years now. I'm 20 years old now. I'm hoping to be somewhat of a value investor like Vitaliy you are in the coming years. So yeah, basically that's it. I'm going to finish university next year. So yeah, hope for the best.
Good luck.
Thanks. So as I know you, Vitaliy, you are an active value investor. So meaning you're not the buy and forget to sell types. So my question would be whether you sell your entire positions when those surpass your fair value estimates, even if you don't have any other investment ideas to put your capital into. So do you rather hold cash, or are you not concerned about reinvestment risk? Because I find when I make good choices and my initially undervalued stocks become fully valued at least, then I'm hesitant to sell when I have no immediate alternative to invest in a better risk-reward stock. But should I sell anyway?
Okay, so I think it's a great question, and I think my answer to the question has changed over the years. So I think it's probably would deviate from what I would have said in probably one of my books. So let's say you have two companies. One is I'm going to pick on a company just hypothetically. Let's say it's a McKesson. So it would be a company that's very slow growing. So that would be one company on one extreme. On another extreme, you have a company that is growing very, very fast. Okay, so the company that is not growing, that's slow growing company, the range of its fair value is going to be fairly narrow, right? Because what creates, what increases value over time is really, the growth, the earnings going higher and higher. So for companies like McKesson, for instance, I would have a narrow band of when I want to sell it. So let's say we would sell it when it gets to 90% of fair value, and maybe sell 1/3 when it gets to fair value, maybe another third when it gets above that, or maybe just do 50-50 and sell 90% at 50% at 90% fair value, and then the rest at the fair value. When you have a company that's growing earnings at a very fast pace, time is actually on your side, and there you want to be selling in the much smaller increments. We owned a company called Twilio, and we've been selling it in a very small, like 15-20% increments over time, because as company grew its earnings 30-40% a year, or revenues 30-40% a year, the value has been increasing as well. So with companies that are growing at a faster pace, so analogy would be like when you walk a dog, you have a leash that's very tight, that's very smallish. So that's what you want to, that kind of leash for companies that are not growing, or growing, maybe at 3 or 5% a year. Companies that are fast growers, you want to have a much looser leash. So the band of fair value should be much wider. And then I think when you sell it, you probably want to be selling it in smaller increments as well. So I hope I answered your question.
Yes, absolutely. Thanks very much. And I have another one, if I can go ahead.
Sure, go ahead.
And that one is regarding valuing businesses using any sort of discounted cash flow methods or any of its extrapolations. So I would like to ask you if you're not concerned about the righteousness of your input assumptions, because I mean the method that is extremely sensitive to all inputs. So if I, let's say, change the discount rate from 9 to even just 9.5 or even 10% probably, then that's going to lead me to an entirely different price. So how do you deal with that? Or are you that confident about all your assumptions regarding, growth rates, discount rates, terminal value, etc.?
I like the process of discounting cash flows because it puts me in the shoes of an investor, and that's why I like using it. However, the way I look at discounted cash flows, it's incredibly valuable at the extremes. When a company, like if you own a company today, I'm not going to mention that company name, but Brendan knows that company, what I'm talking about. And with that company, it almost doesn't matter which assumptions I put in. If I put a 12% discount rate or 8% discount rate, it doesn't matter what numbers I put in, it's still insanely cheap. So at that point, actually, discounted cash flow gives me the confidence to say, okay, this company is unbelievably cheap. So, and therefore, no matter how much it's hated, gives me the confidence to go and buy it. Okay. At the same time, what I discovered over the years, discounted cash flows is very useful at the extremes. Okay. It's a useful and then you look at the company, I don't know, like .com stocks in the 90s, and you put them through discounted cash flow models, you would realize that the impossible things have to happen over the next 20, 30 years for them to be undervalued at the time. So for almost every company we buy, we go through discounted cash flows, but we almost look at it as kind of a shotgun approach, kind of gives us kind of a range of values. And if let's say it's we put different assumptions and we get a stock worth between $40 and $60 and the stock today is 10. Well, I don't have to worry about that $60 anymore, right? I just have I know that with my conservative assumptions, the stock is still very, very cheap. So you're right. Discount cash flow analysis is incredibly sensitive to the inputs. Therefore, you want to be extremely aware of this. And when you change assumptions and suddenly, company you thought it was undervalued now becomes fully valued, you think, well, maybe that's not cheap enough. So that's, hopefully that was a helpful answer.
Yeah, absolutely. Thanks. Because the reason why I've brought up this question is because, you sometimes can read, for example, research articles, which I put all the inputs together and then the stock is like, I don't know, 7% undervalued. And it always seems ridiculous to me because a tiny change to just one of the assumptions would change that dramatically.
Yeah. Well, thank you very much. I appreciate your questions. Thank you.
Thanks, Mate. Okay, so we're going to go next to Arpit Jain. Arpit, take it away.
Thank you. First of all, I've recently sort of got across Contrarian Edge, and I've read historical articles and the current articles that are being sent out on email. And first of all, they are like really great. And the best part that I like is that they really look unbiased and totally rational, which is the thing that really I find very useful. So I basically have two questions which are kind of interrelated in some sense. So one of them is basically, given that what's going on in terms of the monetary policies across the world, especially the central bank in the US, and also previously the central bank in Europe and Japan, what they've done is that they've basically gone ahead with a lot of quantitative easing and bringing down the interest rates. And likewise, the governments in those countries, they are ballooning with fiscal debt, so to speak. So I just wanted to understand what are the potential or theoretical risks associated with doing these things. And secondly, if this persists for longer, then would it be okay to assume, or would it be wise to assume, that financial markets in the world and the real economy, these two would be having a lot of disconnect from each other, which is kind of what we are seeing right now?
Yeah, it's great questions and difficult questions. A few hours ago, I talked to Ed Chancellor, who wrote a phenomenal book, Capital Returns. By the way, if you're a student of value investing, I highly recommend you read that book. Anyway, and Ed and I were talking about this, and he made a very interesting point. He said, if you think about what's happening today, you basically have in 2008, you had a consumer debt skyrocket. Corporate debt did not go up much, and government debt went up. Today, corporate debt is at the probably close to I'm not sure it's all-time high, but it's a very high, and the government debt is exploding. Like we're probably going to add $4 or $5 trillion to GDP or more after we're done with this. But what's interesting about this, debt has different impact depending on who has this debt. So when a consumer has this debt, that's actually deflationary, because what happens when you have a lot of debt, that means you have less discretionary money. You have less money to buy, to go to the movies. When corporations have this debt, this is going to be somewhere in between, right? It's probably still going to be deflationary, but maybe less deflationary than if it was, if the consumer was deleveraging. But it will still slows down the economy, and it's still deleveraging. When government has a lot of debt, which is happening today, I think there is a good chance that this is very inflationary, because what happens when the government has a lot of debt, and God forbid interest rates go up a little bit, then suddenly, government has to take the money that it used to pay, spend on Social Security, and that money, so that debt starts, the interest payments start competing with the Social Security payments or defense spending. Okay, so unlike consumer corporations, government does not really do a good job cutting expenses. What government do a good job doing is printing money. So what they'll do, they'll still pay Social Security, still pay for Social Security, they'll still pay for defense, and they'll just print money. So that is inflationary. So you have a deflationary force on one side that's coming from the fact that you're probably going to have. So this is a very complex question. So I almost can't really answer it without talking about the coronavirus in greater depth. So I look at coronavirus as kind of, you have AC, you have BC, DC, and AC. You have before coronavirus, during coronavirus, and after coronavirus. You have these three eras, three time periods. And when I think of these three time periods, that the length of during coronavirus will have a tremendous impact on how the after coronavirus environment looks like. In other words, if today we are still in lockdown, right? But let's say we open up the country tomorrow, 100%. So government says you can do whatever you want. So I think what's going to happen tomorrow, the restaurants will still be empty, maybe less empty than they are today, but will still be empty, because we still don't have a cure, for coronavirus. So therefore, people will be afraid to go to restaurants, because when you go to restaurants now, what happens is that the cost to that meal is not just what you pay to the restaurant. Also, there's another cost, which is a risk of getting the virus, a risk of getting sick. So my point is, if the economy was open tomorrow, the most likely, the economists estimate that the estimates actually for second GDP, for second quarter GDP range that will be down between 9 and 50%. Just think about it. The economy will be down between 9 and 50%. I think Goldman Sachs is probably, I think, a 35% decline of GDP in the second quarter. Just think about it. Normal recession. When we have a normal recession, real economy declines 3%. That's what we freak out about it. Market, when the job number comes out and it's not a good number, the market declines 2 or 3% because market is scared of the 2 or 3% recession. We are talking about economy being down 30%. Okay, so my point is this: the longer we have this, the fear of coronavirus, the longer a good part of the economy basically operates at very low occupancy. So the restaurants are empty, the barbershops will be empty, the movie theaters. The longer that happens, the bigger impact it's going to be on the economy, because right now the economy is still bending. Okay, and if the fear is gone tomorrow, it's going to snap back very quickly. Now, if restaurants are at 20% occupancy for 6 months, they'll start going out of business. And if you run a Mexican restaurant and you go out of business and the virus is cured and now the Italian restaurant comes back to replace you. Now it's a different corporate unit, so it takes longer time to reincorporate again. And so what's going to happen? So the point I'm trying to make, the longer this time during the coronavirus lasts, the bigger consequence is going to be to the time after the coronavirus era. And so obviously government would have a lot more debt, the unemployment would be higher. So I guess the argument I would make is that we probably would have a lot, it's very difficult. I would have thought we would have had inflation over the last 10 years. Obviously we didn't. But I think the chance of inflation go up more and more as the government debt piles up more and more. So I hope I answered your question. What was your first question? That was your second question. What was your first question?
The broad question was that given all this, will it be like a case where the real economy and the financial markets, they sort of run their own ways essentially? Like the economy, there is a great chance that the economy is not going to recover anytime soon. But given that there is unlimited printing of money and so on, that the financial markets just run their course and they keep afloat and somehow.
I think
is there a possibility of that?
Yeah, I think the financial markets and economy can be disconnected for some time, but not forever. So I think it's at some point they'll converge.
Thank you so much for taking my question.
My pleasure.
By the way, I forgot to introduce myself. Sorry about that. So I'm Arpit. I am a computer science and engineering graduate. I right now work in a software firm in India.
Thank you for joining us.
Thank you. My pleasure. Thank you.
Thanks so much, Arpit. One thing that's really great about this whole process is that, we have this really global group of participants. So next, I wanted to...
By the way, we can't see you now. So.
Oh, I know, but that's okay. We only want to look at your pretty face, Vitaliy, so no worries.
I'm not sure that's the case, but that's okay.
Okay, so I've got Graham. So, Graham,
hey,
you wrote in with a question. Would you mind just introducing yourself, and then you can go ahead and ask your question.
Hi, I'm Graham. I've been writing Vitaliy a while. I haven't corresponded with you, Brendan. I'm from Trinidad, and yeah, I've been following Vitaliy for a while, reading his articles, and they're always very insightful. So yeah, it's a pleasure to be on the call. Thank you for having us.
Joining us.
So my question is a very simple question. I just wanted to know, as much as you could say right now, given the market decline, where are you guys, or in what areas are you guys really finding opportunities? I know the market would have been high towards the start of the year, hitting record highs and so on. And given the downturn, opportunities may have come up depending on where you looked. So is there anywhere that you specifically see opportunities that you can comment on?
Sure. So I'm not going to talk about individual stocks, but I'll tell you this. So from today's perspective, when I look at stocks today, I kind of look at them on two extremes. Okay, and I'll give you two extreme examples. On the one side, you have a pharmaceutical company, and I'm just going to name a name just so you can visualize it better, like Pfizer, or think about any large pharmaceutical company, one side. And if you think about Pfizer, their business has not changed much at all over the last 2 months, right? If you're taking medicine, you continue to take medicine. So it's not discretionary spending. Then on the other side, you have, and I like to use this example because I was just there 2 months ago, and I can just, this is the extreme example. Think of a small hotel in Venice, so people usually don't go to Venice for a business trip. So it's completely discretionary spending, right? So that hotel today is completely empty. Okay, so you have you have two extremes, right? You have this non-discretionary spending, Pfizer, and on the other side you have a hotel in Venice. And so when you look at companies, a lot of them fall somewhere in between. So you look at Chipotle today, and Chipotle, yes, their restaurants are closed to dine in, but their business for takeout is very strong. So they may be somewhere closer to Pfizer, maybe in between. Then you look at movie theaters, and they're right on the side of that hotel in Venice. So the Pfizer's business is very unlikely to be impacted much by the duration of this kind of what I would describe a DC era, during the coronavirus era. So the hotel in Venice or other businesses that are closer to, to that extreme, they will be impacted tremendously by how long this environment lasts. Okay, and they will be impacted significantly because the longer that you stay closed, they may stay closed for a month, they're fine, but when it becomes 2 or 3 or 4 months, they start going out of business. So what we try to do at IMA is basically ask ourselves a question: what will not change even if the virus lasts 6 months or a year, whatever? And so what we found, there are some industries, and there will be exceptions, but there's some industries that probably won't change much. And by the way, the list is longer, but I'm just the ones that we found where we found opportunities. It was a healthcare, defense, tobacco. Those would be industries where we probably have the biggest exposure. So that's how we approached it, because we're hoping that this is over in a few months. Gilead has a cure, or there's a vaccine, vaccine or whatever, or the sun comes out and the virus just dissipates. Who knows, right? We hope it doesn't last very long. However, hope is not a strategy. So therefore, when position our portfolio, we want to err on the side that it's going to last much longer, and therefore we want to stay on the side of not a hotel in Venice, but on the Pfizer's side, on the, basically sticking with companies whose business, telecom would be another one actually. They sticking with businesses whose cash flows will not be impacted by the virus because their products are non-discretionary, etc. So that's, Graham, hopefully I answered the question.
Yeah, perfect answer. Thanks. And thanks for taking my question.
My pleasure. And by the way, somebody asked me if this is wine. No, this is coffee. So.
Okay, let me see here. So next, I'd like to ask Biamba to please ask their question.
All right. Thank you for hosting this, Vitaliy and Brendan. I had an opportunity to meet Vitaliy before, and ever since I've been following him, reading his blogs, and the podcast is amazing, by the way. So love the podcast.
Well, you got to thank Brendan and Elliot for that because they work on this together. So.
Everybody in the team, appreciate it. I consider myself a value investor, but I always like to be flexible. So I guess active value investing is definitely my approach. And so my question is regarding the current environment. Would covered call strategy be a good choice? Because I've been using, Delta Airline is one of my options. So I know Delta position from my research, they're one of the highest quality airline stocks out there. So I believe once we come out of this, their stocks will definitely rebound. But like you were saying previously, it may take some time to reach there. So I've been writing call on Delta and hoping to generate some premiums on it. And I wanted to hear your opinion on using covered call option strategy while waiting for the value stocks to rebound.
I'm very conflicted, and I think this is a strategy that has to fit your personality a little bit. So to some degree, it's better to do covered calls today than it was 2 months ago, right? Because the volatility is more expensive, so the premiums are more higher, right? So
exactly.
So from that perspective, it makes sense. The problem is, it's almost like, this is, like when you do dividend investing, the danger, and I spent a lot of time talking about dividend investing, but there is a similarity here as well. So when people just focus on investing in dividends become kind of this shiny object, which almost derail your research. Not necessarily derail, but they basically, you start looking not at businesses, but you start looking for dividends and then just justifying buying a stock because it has a high dividend. So it becomes kind of a shiny object, which could actually have a significant impact on the construction of your portfolio, not in a good way. I fear the risk of this strategy, at least you want to be aware of that risk, is that you start looking for companies where the premium is high enough. And so you start buying companies not necessarily, like let's say normally you would never have bought Delta, hypothetically. Mm-hmm. But now you're buying Delta because, you can make a lot of money on dividends. I mean, not on dividends, on writing calls. And the risk you run in this strategy is that you end up playing with stock you would not have played otherwise. And so you make money on calls, and then you just lose all the money on just because you bought lower quality company than you would otherwise. So I'm not saying you shouldn't be doing this, just trying to point out a risk. And then another risk is basically the market rebounds and suddenly you get, those stocks called away from you, right? And then your upside is capped. So those are the risks that you're taking when you're doing the strategy. It's maybe appropriate sometimes. That's not something we do, but I know the people that do this, and all I'm doing is just pointing out the risks. That's it. But I'm not saying this is not something you should be doing or should not be doing.
Yeah. I usually don't mess with options because I'm not very fluent with them. But I always remember Warren Buffett's quote saying, "Be greedy when everyone's fearful." So this is me just being greedy during this time. So given that, what's your opinion on the oil? And do you think we will see a rebound once the market opens? And do you think if that rebound will be significant as the drop was?
So oil, I think the longer the oil prices stay at this level, the more likely that we're going to see much higher oil prices, because what it does right now, it's basically destroying supply. So you're going to have a lot of companies going out of business. And it's if you think about oil, it's very simple, right? In the pre-coronavirus era, you consumed about 100 million barrels a day, and you produce about 100 million barrels a day. Today, if after coronavirus, our consumption comes back, let's say to 90, I don't know, whatever that number is, 80 or 90 million or 95 million barrels a day, and suddenly the production is behind us, is less, you're going to have much higher oil prices. The one risk there is, I think, the China, when I look at China in the past was kind of the incremental consumer of oil, and they drove, as the economy grew, the consumption went up. And if that economy kind of goes through, because this is I'm going to open up a new can of worms, but China did not go, we had problems going into this, crisis. China had its own even bigger set of problems going into this crisis. When I was talking to Ed Chancellor, he reminded me about this article I wrote about China 10 years ago, when I basically compared Chinese economy to the bus from the movie Speed. I don't know if you guys remember this. It's the movie.
Yeah.
Keanu Reeves, yeah, exactly. Dennis Hopper was the bad guy. He wired the bus to blow up if it goes below 45 miles an hour. So, Chinese economy, I felt it's very similar to that in a sense, to that bus, because it had so much debt and it needed to have growth at any cost. And if the growth slows down, suddenly, they're afraid they would have a, social unrest, etc. on their hands. So to me, China is a wild card. If it wasn't for China, then I would say, yes, most likely oil prices would go through the roof. What happens to China is going to be kind of the wild card that may prove me wrong. So I don't know. But that's how I'm thinking about it, at least.
What should I keep an eye out? What kind of news should I keep an eye out from China? What do you think will?
I think you want to look at not the official numbers like our GDP grew 6%, because those numbers are highly manipulated. Mm-hmm. You probably, during the financial crisis, I looked electricity consumption, production or consumption numbers. Mm-hmm. And then there were some other numbers that are kind of more difficult to manipulate. Maybe look at imports and exports, this kind of stuff. I forget, there's some other numbers you can look at China. There are secondary numbers that are a lot more difficult to manipulate.
All right, that's great. Thanks, Bianca. Those were really terrific questions. Okay, so next.
Can I ask a question? Do we have any DU students on the call?
DU students? Actually, I wanted to mention this. You should be able to raise your hand. So I just want to encourage everybody, especially if you're a DU student or if you're a student in general, go ahead and raise your hand and we'll take a question from you. We've got a question here. So we've got Andrea Lisi. So Andrea, I'm going to make you a panelist. Andrea, you raised your hand. Thank you for raising your hand.
Hello, can you hear me?
Yes.
I can hear you.
Hi, how's it going?
Great.
I'm Andrea, calling from Maryland, but I'm originally Italian. And I'm the director of commodity acquisition for a multinational here in the US. But my background, I grew up as a quant in the second biggest insurance in Italy. And I have a couple of questions for you. The first question is more of a comment relating to the first colleague that was calling from Hungary. and he was asking you about, the sensitivity of discount cash flow model to valuing stocks, right?
Mm-hmm.
In my opinion, also because of the sensitivity, for instance, on the terminal value, right? In the formula, I think also to do sensitivity analysis on the input could also help giving a kind of range of outcomes that maybe can guide the investor, right? To a more educated guess about the potential outcomes, right? And I would like to ask you if you agree on that.
All right, I'm gonna approach this. I'm gonna try to answer this from a very different perspective.
Yeah.
I think Keynes who said it and Buffett repeated it. I would rather be vaguely right than precisely wrong.
Yeah.
So the discounted cash flow analysis is a vaguely right model, okay? Mm-hmm. And that's how you want to approach it, okay? So like my favorite company to analyze is where I can do my analysis with a crayon, okay? Because I can just take a crayon from my 6-year-old daughter, take out a napkin, and figure out what the company is worth, like in the very simple terms, right? Because then it means it's very, very cheap. I don't have to be brilliant, right? I'll give you an example. Like I wrote a few articles, like I wrote a lot of articles about Apple, but in the 2012, 2013, I wrote a lot of articles about Apple when we were buying Apple stock. And at the time, if you look at my discounted cash flow model, if you look at my models, they were crayon models, right? Because the stock was so cheap that my assumptions did not have to be like, I didn't have to be wrong in terminal, I didn't have to have a precise terminal value. I could be very vague and I would still spit out that the company is cheap. As stock appreciated, my IQ had to go up with, with the stock price, right? Because now I had to think about it, okay, what's the replacement cycle for iPhone? Is it 2.5 years or every 3 years, right? So the point is this, that model is a very vague, so you should approach it as a very vague model. And whenever it spits out a very precise, but the problem is math, right? It gives you a number that if you want, you can carry it out to 10 decimal points, right? Yeah. But it still gives you one number. So you should really be very careful when you use this discounted cash flow model. And really, like whenever you start tweaking with the model, and so that part of the answer would be the same. And you realize, well, if I just tweak this a little bit, now the company becomes overvalued. Or if I tweak, then it's very much possible that you're probably looking at the company that's kind of, maybe the range of fair value is here, and maybe it's right here, something like this. That's point number one. Point number two, the way I like to use discounted cash flow model is basically trying to put in extreme assumptions and see how these extreme assumptions compare to the stock price today. Mm-hmm. Okay, yeah. And I think it's whenever stock is down a lot, right? It's a lot of times it's very difficult psychologically to buy into the stock because you are on the lonely side of this trade, right? Because the world hates it, and you have to have this, and you have to be arrogant and say, the world is wrong and I'm right, okay? Mm-hmm. Your arrogance could come from different sources. Your arrogance could come from a source saying, well, I'm a smart guy, girls seem to like me, my parents like me, and therefore I'm going to buy the stock because I'm going to be brave, I'm going to buy the stock. So that's one type of arrogance. But there is another, what I would call thoughtful arrogance, is when you do research, when you play with different assumptions, when you and you try to kill the business and you can't. I know that's to me, that's a thoughtful arrogance based on research. And discounted cash flow model becomes very beneficial in that case, right? Because you're basically coming to the conclusion that yes, the market is concerned about this, and this. And when I put this into the model, I still think the value is much higher than worst case scenarios. Yeah. That's how I would approach, any kind of modeling you do. So in fact, that's most of the modeling we do at IMA. That's what we spend our time on. It's not like a lot of times, especially when it comes to discounted cash flow model, it's not what the company is worth. It's what it's not worth. Like, if we do this, and this, if these things happen, would we lose money or not? So that's how, this is a very long answer to a very good question, by the way. So.
Oh, thank you. And then my second one would be relating to portfolio analysis.
Yes.
If I think about value investing, I mean, I've read some books about Benjamin Graham, right? Which is one of the most famous value investor of all times, right? And also in his book, he was thinking about how to share between equity and bonds. Now, after 80 years, it seems that the world is upside down with all this quantitative easing, zero interest rate. Do you think that at this point of time, maybe having bonds in a portfolio, even government bonds, is as risky as having stocks? And because usually the bond side of a portfolio should be kind of an edge. I see now also bonds that are very, very expensive. So would certain areas of equity investing, like value investing, be the new bond part of a portfolio?
Okay, so let's try it. Let's try when you think about bonds, let's think about 3 risks that you take when you buy bonds. Number 1 is the duration risk, right? So if interest rates go up and the stock price declines, so that's one risk. Number 2 is a default risk, right? So when it's a company goes out of business, and so you don't get your money back. And third risk is basically inflation, right? So the payment you receive is less than the inflation that's, okay. So the corporate bonds today, basically, bonds today in general provide very low return overall. I'm talking about investment grade bonds. So there's some areas in the bond market that were distressed a few weeks ago. I'm not sure they're distressed anymore, right? But so when you are buying bonds that you would in 10-15%, whenever we had a dislocation, right? But I would argue that type of investing is a lot more closer to equity investing than just kind of what you describe in the kind of conservative bond investing, right? So the corporate bonds in general today not providing much yield, and the interest rates are very low today. And could they go lower? Why not? Could they go negative? Why not? Okay, but would you want to take a risk that if that interest rates go up and suddenly you would lose a lot of money, right? Because today you basically when you buy bond like long-term bonds today, you're basically getting return-free risk, right? So the bond market in general does not excite me. However, today, almost to me, you have 2 assets really. Kind of, you have cash, which what used to be kind of short-term bonds, right? Or short-term bonds, government bonds. So there is no default risk there. If you own short-term government bonds like T-bills, there is no default risk. And there is no interest rate risk. In other words, there is no risk that interest rates go up and and the value of your bonds decline. But you still take an inflation risk, right? That the inflation will eat away the buying power of your of that asset. So I would argue if you could find a very high quality company that has pricing power, and that should be pricing power should be part of the definition of high quality, that has a good balance sheet, again, high quality company, and you buying it very cheap, so you have a significant margin of safety, and this is the key point, actually, I should have started with that, and you have a long-term time horizon, right? So you're investing for the next 10 years, right? So you don't need this money for the next 10 years. Then I would rather own that type of company than almost any bond out there. But however, if I can't find a portfolio full of the stocks, then I would rather own the short-term treasury, waiting for opportunity to buy the stocks, Okay, but in other words, I would approach the kind of short-term treasuries as a placeholder, waiting for high-quality, undervalued companies.
Thank you.
Great.
My pleasure.
Thanks so much, Andrea.
Thank you.
Just want to again just highlight how grateful and honored I am that we have such a great diverse global group of people here that we get to interact with. It's really an honor.
Absolutely. I agree with you.
Our next, Vagram, are you there?
Yes, I'm here. Can you hear me?
Please, yeah, we can hear you. So go ahead, please ask your question. Go ahead. Thanks for raising your hand, by the way.
Yes. First of all, thank you very much for adding me to the call. And I would like just to say big thank you for all the work that you're doing, all the help to the community. I enjoy reading the newsletter of Vitaliy, and I follow him on Twitter. So Vitaliy, thank you very much.
Bagram, my pleasure.
I missed the opportunity to see you in Zurich because I live in Geneva. I was on a business trip, but thanks to the technologies, I can catch up and actually ask some of my questions to you directly, and that's really awesome. So I had a few questions. The first question was about the current situation. There seemed to be a huge divergence between the market sentiment because like we could see a very strong rebound in the equities, but we're heading in a very severe recession that is coming soon. We don't know how severe it can be, but there seems to be quite a lot of optimism. I would like just to ask what you think. Do you think that there is actually divergence in the sentiments between the market and what's coming ahead? And also another question about the current situation, are you looking into any specific data related to the virus, like any statistics, any like a number of deaths or number of tests that's done? Are you following this, or you think that maybe it doesn't make any sense?
That's a good question. Thank you for those are good questions. So the market is, is basically, I haven't looked at it, I haven't looked the last couple of days, but it's probably very close to a level where it was in 2019, sometime like in mid 2019. So basically, it's almost as if, the coronavirus kind of did not happen to some degree, right? Because, and if you look at some of the hotel stocks, they are, some of the travel stocks, they're basically, like they don't look, they don't look that cheap, even if the virus, even if they didn't have this, right? So and I just use that as an example. So I'm not sure how much behavior of the market today is influenced by Federal Reserve just basically underwriting the bond market. To your point, yes, I think when I look at the stock market today, it doesn't look to me like it's pricing in a potential potentially severe recession, severe recession ahead of us. The funny part is this: if you look at our stocks, and everybody loves their stocks, and I know this, but if you look at companies that really kind of more or less detached from the economy, and those companies are still cheap. So there is the economy. So the value is still kind of in the doghouse a little bit. What was your second question? Oh, if I look at so I have some friends, so it's kind of interesting. I have some friends who spend 10 hours a day, even almost putting their own databases of data and trying to track different countries, etc., how they progress different country. To me, I spend very little time doing this. I kind of try to stay in a very high level because I realize there's so little value I can add there. Like, they can track all these trends, and then think about the sun comes out, and maybe this virus goes away. It may not go away, but we don't know this, right? So you do all this work, and all this work could just, become worthless just because sun came out and the virus went away, or Gilead or Bill Gates Foundation comes out with its own set of vaccines. So I basically, in the beginning, I tried to play this game, and then I realized I can add so little value there. And so what I'm just, I spend most of my time thinking, okay, what will not change? And that's kind of, and we try to err on this side, like, on these companies that won't change in our analysis. And then I also think about what will change, but from a different perspective. And this is something we haven't talked about today. The virus will accelerate a lot of trends that were already in place. Right? So let me just give you this example. 2 months ago, if employees said, I'd like to work from home, maybe companies would be resistant to that. It's possible that after what happened now, companies going to be a lot more receptive to have their workforce, a larger part of the workforce working from home. So what it may do, it may change even after the coronavirus goes away and we forget about the virus, right? What it may change is that we may discover that we have too much commercial real estate. So I start thinking about, I spend a lot of time thinking about this kind of trends. So anyway, so that's kind of, but I spend very little time. I spend very little time trying to model Singapore or the coronavirus in Singapore or in Spain or whatever. So
thank you very much, Vitaliy. Can I ask one more question?
Absolutely.
I wanted to ask if this virus and the upcoming crisis has changed your investment approach. And are you looking, for example, at insider transactions, for example, particularly at this moment?
I mean, we always have looked at that, right? So our investment approach has not really changed. I think the virus introduced kind of new variables, right? It's kind of new variables that we didn't have to think about before. I never had to think about, well, can this business survive if it's closed for 6 months? Like really, we have exposure to 2 retailer stocks, and in our analysis before the virus, we were basically stress testing it. What happens if we go into severe recession, and we would go look at 2008 data. Right, we would look at 2008 data and say, okay, well, how did this business, what did this business do in 2008? Because that was not a normal recession, that was a very severe recession, right? So that was our analysis, kind of before the virus, right? But I was not, the thought of, thinking, okay, would this retailer survive if their store is closed for 6 months? That was not part of my stress testing, right? So today it's you have to you have your own set of new set of analysis like that introduces kind of new variables that we didn't have to think about before. But our overall approach has not really changed philosophically, or even I always like to see when insiders buy in stock, like significant amount of stock especially. I'd love to see that. So that hasn't changed because,
Thank you very much for taking my question. That's really valuable to have opportunity.
Well, it's my pleasure. Thank you.
Thanks, Vagram. Okay, I think we had another question come in through the transom here, and I'd like Kurt. Kurt, are you able to speak, Kurt?
Yeah, can you hear me?
Perfect. Yeah, go ahead. Kurt.
Yeah, I'm a geologist. I live in Denver. But I'm interested in your approach and kind of how coronavirus has created kind of exploring the tail risk and how that might have changed your screening philosophy as you look at value opportunities. And also as you do that, thinking about, I've heard a couple people asking questions about recoveries in the US or recoveries in general. In the US, we've kind of been at a fairly expensive point as far as ratios go. And so thinking about large cap, small cap, US, non-US, tail risk and screenings, curious your thoughts on or how you might have evolved your thinking for the current time.
Yeah, I think it's a great question. So there are actually a couple questions inside of it. So number one, so one thing we've been spending a lot more time doing now than ever before, spending a lot more time on balance sheets, but not just on balance sheets, spending a lot more time looking at liquidity. Okay, if a company has debt coming due, over the next 6 months, and they don't have cash on the balance sheet to pay over the debt, then that presents a significant risk. So we spend a lot more time looking at liquidity. That's point number one. Point number two, I think I think probably, and Brendan, you can probably set me straight. I think half of the buying we did over the last months or two was outside of the United States.
That's right. Yeah, there's a fair amount of non-U.S. exposure that increased.
Yes, and it's not, it's not because we're not patriotic and we don't love the United States, but it's just because a lot of times we can find high quality companies that are incredibly cheap outside of the United States. And then you about large caps, small caps, or mid caps. We're always kind of cap agnostic. Because all we're trying to do, because we're looking for high quality companies, and characteristics are for the most part agnostic to the size of the company. You can have a very large company that has no moat and has a bad balance sheet, and you can have a small company, a relatively small company that has a great balance sheet, great management, and has significant advantage. So the size, you can argue that there is a survivorship bias in larger companies because only great companies float to the top, and there is and so maybe if you look at our portfolio, probably have more larger companies because of that. But but when we do searches, I think we just maybe put a few $100 million, like we look at $350 million companies or larger, just because of liquidity. So just when you buy a company, I don't have to buy 50 shares a day, kind of thing. So, but in general, if you can find high quality companies that's run by very good management, and it's a small company, and actually, in fact, we own one company in Norway that's probably $800 million market cap, and so that would be considered to be a small cap. So, Kurt, did I answer your question?
Yeah, the small cap, large cap comment was also about, if I'm correct, there's historically been coming out of these kinds of like recessions, however long it takes for us to get through this, but that small cap comes back stronger than some of the large cap. And I think from the value side, that's kind of what I was thinking.
Oh, yeah, no, and that's true. And also, it's not just that, but also the kind of low quality companies. And I don't want to equate low quality to small cap. That's not what I'm trying to say. But usually small caps, you're right. The small cap index today, I read somewhere, is down still 30-40%, even though the market is down 10 or 12. So the small cap index is down a lot more. That's why it's going to come back stronger when it's over. And also kind of riskier companies will come back stronger when it's over. The only problem is it's a path, and now I'm not talking about the risky companies. I mean, small companies. I'm talking about riskier companies. It's a kind of a path-dependent comment, because if this thing is over in a month or two, then like low quality companies will skyrocket, right? Because when you come out of a recession, usually low quality companies come back much faster and appreciate much more. But the issue is this: the reason we don't have a portfolio of crappy stocks, because it's a path-dependent comment, right? It's if the virus, if we are still struggling from the virus 8 months from now, a lot of those low-quality companies that with bad balance sheets may not be around in their current form, and therefore they may not come back because they went bankrupt. So, and about small caps, I usually don't like to think of small, medium, large. I just try to think of them as businesses. So crappy small caps may not come back, and the ones that are very good, they will come back very fast. So.
Well, thank you.
All right, my pleasure.
Thanks so much, Kurt. That was a great question. Just want to highlight again, don't hesitate to raise your hand and, ask a question, because, usually I've found that, especially when I'm doing investment research, if I have what I think is a silly question, it's actually uncovering something really valuable. So it's especially true when doing, talking to management and things. So, go ahead, raise your hand, ask a question. You can ask it in chat. There's a Q&A format you can ask. So, don't hesitate. We've still got some time. So next we've got Ignacio. Well, Ignacio asked, I'll ask his question. He asked, what is the role of gold in an investor's portfolio?
Well, I struggled with this one a lot because I think the issue is this, that even before the coronavirus, our government basically showed that even when you run huge deficits, you can lower taxes, right? And you just run bigger deficits. So and when you do this, you're basically debasing your currency. Your currency should be worth less than it did before. Except the only problem is when you have one currency, currencies don't exist in isolation. It's a comparative game. So other governments did the same thing. So therefore, that's why US dollar has not really depreciated that much, or actually probably appreciated. So, and the benefit of gold is that gold basically you cannot create more of it, right? So it's in the ground or it's in the ground above the ground, and it's a very tedious process to get it from the ground. So the problem is gold, though, you have no idea what it's worth. Like when Brennan and I debate Microsoft, debate Pfizer, we can have a discussion what it's worth, and we can talk about our assumptions, and we can kind of to come to some kind of value, to what it's worth. This gold, it's really a story. It's a story that this is currency and it's existed for a long time, and therefore it's worth something. How much it's worth, nobody knows. To me, it became a little bit even more appealing after our government, just basically our Federal Reserve created $1 trillion worth of money out of thin air, and a government just, is just going to issue $4 billion worth of $4 trillion, not billion, $4 trillion worth of debt to plug the hole that's been created by coronavirus. So, from that perspective, I can see how gold is becoming more and more attractive the more debt we create. The problem is the reason I struggle with that, because every time I'm kind of Brennan comes to my office and says, Vitaliy, maybe should we buy gold? I keep looking at the companies we're analyzing, and I look at them, and the companies I'm analyzing, I know how to value them. I know that they have pricing power. If you have inflation, they can raise prices. So, and I always kind of push. I would always think, okay, should I put 1 or 2% of our portfolios into gold, or should I just buy this company that can raise prices and that I can value and I can analyze? And at the end of the day, so far, every time the question of gold came up, we just bought high quality companies that can raise prices. That's what we've done so far. But even if I bought gold, which it's not a rational thing to do, the problem is I would not buy enough of it. I would just buy a few percentage points, and it wouldn't really make that much difference on a portfolio, on the portfolio level. So these are my thoughts on gold. So Ignacio, since you can't really talk back, maybe you can type and we can, so I don't know if I answered your question or not, but it's a kind of a non-answer to a question, because I guess my thinking on gold is, if you own, I understand it, but here's why we don't own it, because we can find companies that that have the pricing power that we can analyze, and that are that have significant margin of safety.
Okay, I think that's great. I'm not getting anything else right now from Ignacio. So okay, let's go now. I want to go to Brian.
Yeah, hi. I have a question. I dialed in late, so I don't know if this has been asked. First, thank you for having this one. It's super helpful. Thank you for your time, Vitaliy.
My pleasure.
Yeah, my question is, there's a lot of discussion or increasing risk of U.S.-China decoupling.
Yeah.
So I was wondering how you think about it in terms of investing in U.S., also like in terms of investing in China, like if this is a increasing risk along the horizon, like how do we mitigate it? Thank you.
No, I think it's thank you, Brian. Thank you for your question. I think it's a real risk, and in some companies that we own, and I'm not going to mention names, we actually reduced our position size because we realized that decoupling China is a new risk to that business. I think we're probably going to get more clarity as time progresses, which industries will be impacted the most. I would probably see pharmaceutical companies in the past, they relied for API, which is active pharmaceutical ingredients, to come from China. Most likely, they're going to bring this. The U.S. government, I'm sure, if they haven't done it yet, the U.S. government will probably mandate it that APIs are manufactured in the United States, for instance. What this crisis has exposed, and I wrote about this before, that today, until recently, our whole economy was optimized for efficiency. All we are trying to do is try to minimize the cost of production. Okay, so just-in-time inventory was emphasized because this way you have a less inventory on the balance sheet, therefore your return on capital is higher. I think what coronavirus exposed, it's also contorting the weakness when you have disruptions. So I think we were not optimized for resiliency. And I think a lot of companies, just like you as consumers, just think about it as a consumer for a second. In the past, you had one cereal in the cupboard because you knew you can always go to Walmart or Supers and get another box of cereal. Today, we have 3 boxes of cereal, in our closet, in the cupboard, because we are now trying to optimize our household for interruptions in supply chain. So I think it's going to happen on a corporate level as well. I think companies probably going to start carrying more inventory. I think we may have actually a renaissance of manufacturing in the United States. And so it may actually end up being positive for the U.S. to some degree, but it's also, because we're going to have some of the jobs come back, but at the same time, it's going to be inflationary. It's going to be inflationary, but at the same time, it's probably going to result in more automation as well. So it's too early to tell exactly how it's going to play out. One of the previous callers asked me about, this would be one of the things I'm thinking about today. I'm not spending as much time on trying to figure out how's the coronavirus progressing in Spain, but I'm trying to right now thinking about, okay, what are the second and third order effects after this is over? What industries will be impacted? And I think, the question you bring up, I think our relationship with China is probably going to get worse, not better because of this. And this will also have a negative consequence on us because if China was buying Caterpillar tractors before, most likely they will be focusing on buying their own produced, Caterpillar, whatever, Chinese made version of, heavy-duty tractors, etc. So if GM sold a lot of cars to China in the past, you may see less of that happening. So it's a double-edged sword. So today it's incredibly difficult to kind of, to model this whole thing out. So that's my, again, I seem like most of my answers are kind of non-answers because I'm not giving a very clear answer that says this or this, but I'm just, those are very difficult, that's a very difficult question, but I think that's something you should be thinking about as an investor today.
That's great. Thank you. It's great to hear your thought process. I hope to see you in person soon again.
Absolutely.
Brian, thanks so much. Okay, our next question comes from Anshu.
Yeah, hey guys, how are you doing?
Good.
Hey, so as a background, so me and my wife have been having this discussion that, given the huge recession risk that we see coming forth, and not as a scare tactic, but more as a insurance policy, if I may say, we want to, so I'm in my mid-50s and I'm fully invested. And I have been kind of broaching is like move at least 20% or 30% or even a larger half of my portfolio into cash. Any thoughts on this? I mean, I know everybody's situation is different, but just would like to hear your thoughts.
It's a very difficult question, right? Because I don't know what stocks you own. I don't know, if you own a bunch of indices. If you own a bunch of indices, I would say, sure, why not? We are more invested today than we were 2 months ago because this market provides us an opportunity to buy high-quality companies that are significantly undervalued, whose future is not going to be changed by the virus, right? So our cash balances have declined over the last 2 months, not increased, right? So it's very difficult for me to say what you should be doing from this perspective. If you think what you own today is going to be worth more than 3 to 5 years out, and you're comfortable with that, then I would do nothing. So, but it's so that's, but that's kind of my answer to that. And I just one more thing, I would really like the questions come from students if it's possible, because this was more like how to, this is a question, I really like to answer how to fish questions, if it's possible. So so this question is more about the fish, not about how to fish. So
thank you very much.
Thank you, Anshu. Thank you.
Okay, thanks, Anshu. Just as a rule, what I'm going to do is I'm going to let people who haven't had the chance to speak ask a question, and then we've got some follow-ups, and if there's time we can get to those. And Vitaliy, I'll just let you make a call on that. But we've got one more with at least one more. And by the way, as of now, I would encourage people to keep sending questions, and we keep getting these great questions. So so don't hesitate. Raise your hand, ask a question in the Q&A or in the chat. But right now we've got Lorenzo, so I'm going to let Lorenzo.
Hi, Vitaliy. First of all, thank you very much for your time today. I've been watching for 1 hour and a half and still can't wait to hear more. So big thank you.
My pleasure.
I've been reading your books, loving your newsletter. So thank you very much for all the work that you're doing to spread investing around. I've got 2 questions. The first one is, how are you looking at the financial sector right now with the coronavirus and with all of these stimulus that are done by the European Central Bank, by the Fed? And I was interested in investing in some banks in Europe or in US, but I still find it very complicated to figure out what should I look right now in this period, and how should I think also in terms of second level consequences? What should I look into a bank? What can I expect? I mean, I've done some investments already, and banks are not really like my competence circle, but I would like to hear your opinion on the sector and on what you would look for if you would think about investing in financials. So banks or insurances in Europe or in US. And the second question, instead, it's something completely different. I'm not sure even if it's like the right question to ask you, but I'm considering right now with the situation of quantitative easing that is done again by European Central Bank and the Fed, how is that impacting like investing for people that are already retired or they are considering retiring? So they're looking like for some type of products, maybe bonds, maybe some specific type of stocks, ETF, whatever, that are less volatile but still provide a minimum level of return. And do you think there are like some type of products that could be interesting to look into for people who are at this stage and thinking about my parents who are like in this stage at the moment?
So let me start with the second question first. So and this is not a, so for 3 weeks ago, we launched a new portfolio, and this is not supposed to be an infomercial, but just it's really kind of, we did it because it made sense. We launched a new portfolio, high quality dividend stock portfolio. Because for a long time I tried to build this portfolio, clients would come to me and say, Vitaliy, we need a predictable income, and it seems like bond market does not have the answer. Can you build a portfolio of stocks that could provide a stable income that would rise over time? And today we can do this using I think today it's possible to do this using high quality companies. And for the most part, when you do this, to stay away from financials, REITs and like MLPs, like master limited partnerships, like that have exposure to oil or transmission petrochemicals. So we were able to do this, and I think today, the portfolio for us yields about 5.5%. So it's possible to do this. You want to be when you do dividend investing, you want to be incredibly careful that dividend does not become a shiny object that completely destroys your analysis. Okay, so the way we've done it, we basically identified universe of stocks that pay, I think, more than 4% or more. And then we just started to analyze each company at a time and value each company at a time. And if it passes our quality test, then we keep going forward. And then the dividend is just kind of an afterthought at the end. And that's how we created this portfolio. So I would encourage you to do this, go through a similar kind of process. Your second question about financials, there's something you said that really stuck out at me. You said, financials are not my core competency, however. So I would argue that this is like when you buy financial stocks and it's not your core competency, you're going to be such a patsy at the table. So you want to make it your competency before you start investing in this, because you don't want to be a tourist in financial stocks, because this is like not a place where you want to be a tourist. Because the second and third order effects there are so complex. So today we own only one financial stock, and it's not based in the U.S. I would argue that analyzing financial stocks today is incredibly difficult because, and I would argue most of them are incredibly, not all of them, but most of them are very path dependent, because again, if the virus, if we're still talking about a virus 8 months from now, you're going to have much higher unemployment, you're going to have much higher default rates, etc. So I'm basically saying that if you want to start investing in financial stocks, you wanted to make it your core competency before you start investing in them, I guess, or if you still feel very compelled to invest in them, just try to diversify your ignorance, or your lack of core competency just by tiny positions.
That's what I've been doing at the moment. So it's like my way to get motivated to get into financial, build small position, very, very small, that don't have a big impact on the portfolio, and then start to get going deeper into the sector. But I will definitely not overweight them, because I'm still aware that they're not like the place where I've got an edge.
Yeah, so the difficulty with financial stocks is that a lot of times unknowns are known, right? The financials have so many assumptions, right? The cost of goods sold is an estimate that, if you look at a credit card company, for instance, right? Your revenues, what they are, right? Because that's just interest, fees and interest income, right? But you start looking at your expenses, one of the assumptions there, it's the defaults, right? So you look at credit card companies, and the defaults, 2 months ago were 2%, 1.5%. While today, suddenly coronavirus has changed it dramatically, and so you have to have a view first of all, if the defaults spike to, and then now you have to make an assumption, 8, 10, 12%, can they get through this? They capitalize enough. But even after this, you still have to make an assumption, what is the new normal level of defaults? Okay, and this is actually, this is the point I wanted to make, which doesn't relate to this directly. Before coronavirus thinking, until 2 months ago, we've been basically conditioned to think by kind of a semi-normal environment, where like a lot of patterns in our head were like, okay, well, we go out to restaurants, we spend, I don't know the numbers, but probably 60 or 70% of spending, I think, probably for food is at the restaurants, and maybe 30% is at home, something like that, maybe 50-50, whatever. So now I want you to think about it for a second. If we are still scared about going to restaurants, then our spending at grocery stores may elevate and switch from, let's say, 50-50. Now we are spending 70% of our dollars at grocery stores. So if you look at a company like Cisco Foods, the company that distributes foods to restaurants, and you look at the earnings, base earnings, what they made in 2019 as your base, you probably are making a huge mistake, because it's very likely if by the time, by the time this is over, a whole bunch of restaurants go out of business, number of new restaurants created may become a lower number. Also, this virus might have changed our habits, and now we may end up eating out less in general. So the point I'm trying to make is that you have, like, when we look at the past, at what happened in the past, you have to be so careful not to draw a straight line and assumptions that when we come back to normal, the normal is going to be just like it was in the past. It may change. So I know you did not ask me that question, but I'm still giving you the answer that the question you did not ask me. But anyway, so that's my very long answer to a very good question.
Thank you very much. Much appreciated.
It's my pleasure.
Thanks so much, Lorenzo. So let me just give a quick update here, Vitaliy, with where we are. We've got two people that are new. They have new questions, so they haven't asked a question before. Then we've got a few questions in the queue from people that have asked one question. So I'd like to at least get to the two if we can. And the two, by the way, are one from a DU student that had to leave to go to class at 12.
Okay.
And then we have another one from Zambia. So those are both pretty special. So I'd love to get to those if we can.
Perfect.
Okay, so I'm gonna read the question from the DU student. So his name is Jack, and his question is, I listened to Vitaliy's 6 Commandments of Value Investing, and I was rekindled with what makes me love finance. I like investing for the sake of owning a piece of a truly exceptional company, but I have learned many other trader type ideologies since then. It seems that every professor has their own opinion. I also like how simple Vitaliy's models seem to be. So the question, what does a day in Vitaliy's office look like, and what do you spend your time doing? And is this way of value investing sustainable in the future with the increase in artificial intelligence and high-frequency trading? And so Jack says, thank you for your time.
Wow, so such a good question. So it's kind of interesting. So actually, I just wrote this long article that's going to come out this Thursday, which answers actually the question what my day looks like. But there was one caveat. That's what my day used to look like pre-coronavirus, right? Basically, I'm extremely protective of my time. That's probably my most important asset. And so I try, so when I structure my day, I try to spend as much time as possible, focus on research, and try to create this oasis when I can do this. I also find that I do my best thinking early in the morning. So I started to, again, this is a pre-coronavirus Vitaliy. I would get up about 4:30, 5 o'clock in the morning, and I write for about an hour and a half, 2 hours a day. And because I find that I do my best thinking through writing. So the unfortunately, and this is unfortunately what coronavirus did to me, I realized that a lot of good habits that I formed over the years have been completely destroyed over last month. Because so what happened, I stopped going to the office, and so my routines changed. Also, for instance, when the market had very, very high volatility, I worked 10, 12 hour, probably 12-hour days. And I wanted to make sure that I sleep, get enough sleep, so I would stop getting up at 5 in the morning. So I started to sleep in, to get up at 7. And because I started doing that, I would write less. So basically, the habit I created of writing every day, got interrupted. Another habit that I had is that I would work out with a trainer twice a week. And some people can work out without. They can just go to the gym or do whatever and work out at home. That's not me. I need to have an external pressure. I need to have a trainer who tells me, you do 20 push-ups. And that's the only way I could, kind of force myself to work out. And I've been working out for almost 2 years, without interruptions. So now I haven't worked out in basically, 3 or 4 weeks. And then the last one, my diet completely, got destroyed by, basically at home. So overall, I'm very appreciative of the time actually I had over last month, because I actually ended up spending a lot more time with my wife and my kids. But at the same time, there are some consequences. So the reason I'm pointing this out, that there was two Vitaliys: Vitaliy pre-coronavirus, which was a lot more methodical, and Vitaliy that's less methodical and less disciplined today. And I'm about 2 days ago, I started to get up early. I think I get up now at 6 and I write. And I started to walk. Like I walk 30 minutes every morning now. So anyway, that's first part of the question. But the second part of the question is value investing going to be impacted by AI? And actually, believe it or not, this is what I'm working on in my book right now. The book I'm writing, which I haven't touched in months, the intellectual investor. That's the topic that I'm trying to address. How does a value investor evolve in an environment where you are now not just competing against other value investors and ETFs, etc., but you are competing now against artificial intelligence? And I would argue, without giving away the book away completely, that you need to be a lot more creative now than ever before. So being left brain, being just kind of very methodical left brain is not enough. Now you need to actually engage your right brain and be creative. So that's kind of my very kind of three-top answer to your question, because I'm still working through this in my book. So when the book comes out, I guess I'll have a full answer to your question.
Okay, great. That was super helpful. So thanks for that question, Jack. The next question comes from Nkandu from Zambia. And so Nkandu asks, what books can one read to learn how to value financial stocks? And then, you sort of spoke about financial companies being within your circle of competence or not, or whatever. How does one gain competency in valuing a financial stock?
That book you just bought, right? We haven't read it yet, but you just, it came highly recommended, right?
Yeah, so that is a book about a company called Svenska Handelsbanken. I'll circle back with a couple book recommendations, but why don't you speak about sort of growing your circle of competence to actually be able to invest in financial stocks and know what you're doing? How does that work?
So I think the financial stocks in general are more difficult to analyze than many other companies. So I don't have a good list of books for you, and I think Brandon hopefully will come up with some. I guess what you want to do, here's what you do. You would identify some well-run financial companies, ignore the valuation, and just start reading their annual letters by their CEOs. I think Jamie Dimon is probably, who runs JP Morgan, probably I would start reading everything he wrote, every letter he wrote for JP Morgan, every annual letter he wrote. I know Warren Buffett reads it. I would probably, and so just try to identify companies like that basically have done a great job surviving through the crisis, and read the letters by their management. I think that's probably a good way to start. I'm not, the financial companies in general are kind of on the periphery of my circle of competence. So I'm not necessarily the best expert on them. So, but Brendan, you have that book you just got in the mail a few days ago.
So the book is called A Blueprint for Better Banking: Svenska Handelsbanken and a Proven Model for More Stable and Profitable Banking, and it's by Niels Kroner. And so Svenska Handelsbanken is a bank that actually Ed Chancellor, the guy that you just got off the phone with, Vitaliy, wrote about in his book Capital Returns, which is a phenomenal investment book. There's another book, actually I'll do a few more recommendations. So there's another book called The Bank Investor's Handbook. That's by Nathan Tobick and Kenneth Yellen. So I would recommend that one. And then there's another book called Risk and Reward by a guy named Stephen Catlin, and that's about insurance and reinsurance. That's a really phenomenal book. But I would just echo what Vitaliy said. I mean, once you get past a certain sort of basic level of competence, maybe by reading these books, really going to the annual reports of just, banks and insurance companies and asset managers and reading those, in addition to the letters that Vitaliy mentioned, I think is a great way to, just get up to speed and kind of start to see what is good and bad and what works and what doesn't. So in the U.S., you want to focus on 10Ks, and then outside of the U.S. geography, just look at annual reports. And I like to read the whole thing. So read the footnotes, read the management discussion and analysis, and really kind of get into the details. And I think if you do that a lot over time, you'll find that your circle of competence grows.
I was going to say I was looking back to see. I think I have Capital Returns somewhere in my bookshelf, but I can't see it. But what I was going to recommend, so I would read the Capital Returns as well, because it has a very good chapter on banking. Spend a lot of time talking about Handelsbanken, Svenska Handelsbanken. So I would read that book for sure too. Yes.
That's it right there. I don't know if you guys can see me, but Capital Returns, that's the book. So great. So now we've got a handful of questions.
How about 2 more questions, and then we'll go from there? And then we'll wrap it up. Yeah.
Sure thing. We'll wrap it up. And let me do this. So what I'll do like a rapid fire. So first, Oh, we've got somebody that joined that hasn't asked a question yet.
Sure.
I'm going to let him go first. Okay. So Sean.
Yeah. Hi. And I'm actually going to be an MBA student this fall, so I guess I count in that pool. I had just a quick question about kind of this growth reverting to value. I think we saw kind of at the end of 2018 with interest rates kind of rising there.
Yep.
At the end, there was a quick flip. And then last year we saw with the whole WeWork debacle and people were kind of, there was that flip again. I'm just wondering now, obviously, with the economy in a recession and, we don't know how long it's going to take to get out of this whole thing, with revenues coming down, growth rates coming down, do you think investors and the market in general are going to be more focused on profits and margins, and that can help maybe put some sort of, suspended return to value investing?
I'll be honest, I don't know. I think a lot of people got disillusioned with owning ETFs, because I think ETFs were kind of a panacea for a lot of people, because they felt, when I own ETFs, I'm diversified, and therefore it's a low-cost investing, and therefore a lot of risks been diversified away. And what a lot of people discovered, that if you own a lot of overvalued assets, it doesn't matter if you're diversified or not, they'll still decline. So I think one thing that may change, one thing that may favor value investors and is the high interest rates, possibly, because the high interest rates favor value stocks. Because if you think about kind of bond analogy, so the value stock is kind of a low duration bond, and growth stocks, because most of its earnings lie far in the future, they're kind of high duration bonds. So if interest rates rise, suddenly company whose most of the earnings lie 20, 30 years in the future, it gets impacted a lot more. So I think the dispersion between growth and value would decline. But I'm not sure if this is just a kind of wishful thinking on my part. So being a value investor, but I think at the end of the day, value investing is just it's a philosophy, right? It's just a rational thinking. And I wrote the 6 Commandments of Value Investing, which is very few thoughts in that chapter are mine. Most of them are just borrowed from Ben Graham or Warren Buffett. But it's just, value investing is really just a philosophy. It's just being a rational thinker and looking for margin of safety, have a long-term time horizon, looking at risk as not volatility, but permanent loss of capital, this kind of things. So those things really don't change that much. It's just a certain type of stocks, benefit from people not caring about risk or interest rates, etc. But at the end of the day, those things probably normalize in the long run. So that's how I look at it.
Great, thanks.
Thank you, Sean.
Okay, so that was a great question. Okay, I think what I'm going to do is I'm going to sort of make a call here. So we'll end the way we started with Mate. Mate has patiently had his hand raised for like an hour for a second question. So
it's very tired. I'm sure the hand is very tired.
Yeah, he's probably. Yeah, I mean, I want to give him a break here, so we'll end exactly the way we started with Mate. So Mate, go ahead.
Oh, thanks. Yes, my arm has been falling off. Yeah, it's just going to be a quick question, because I've had a thought when someone mentioned Ben Graham. So, have you ever tried net investing? Do you have an experience in buying fair companies at wonderful prices rather than focusing so much on quality? Generally, what's your view on that?
So I just clarify the question. Fair value. What does it mean?
Buying companies below net current asset value, like Graham did back in the 70s.
I haven't really done this, and because a lot of times when you have this, a lot of them are believing a lot of money. So I'm just gonna bring up a company we don't own, but just as an example, like GameStop, I think at some point, maybe it still is, it was trading below cash, right? But the company could start losing a lot of money very, very quickly. So yes, maybe, and I'm just gonna make up a number. Let's say it has $10 of cash, and this is a $7 stock. So you kind of you buying it below that, it's net assets, except it might start losing $1 or $2 a year of earnings, of cash. So how much time would it take for GameStop to basically run through this cash, and suddenly you're paying above net asset value? So that net asset value, I find, usually works when you're an activist. You can come in and shut down GameStop. You say, we're going to shut down the store, we're going to sell off the inventory, and then this $10 they have, we'll realize it. So we'll buy $7 for 10, and then we'll realize it. But a lot of those net nets are basically, it's not like you're a controlling shareholder and you can do this. So this is why we haven't really done this. Let me take it a step further. Brad and I looked at a company in Japan recently that had 90% of its market cap in cash. And it actually looked like a very decent business that was trading, if you take out cash, was trading 1x earnings. And we still struggled with that because the management, they accumulated all this cash because they refused to pay it out as dividends. And you would just kind of wonder what happens, how are you going to make money if this money, as a shareholder, you will never get this money back. They won't buy back stock, they won't pay dividends. So it's a tricky, even in good cases, like, the company Brad and I looked at was a very, high quality business in Japan. So, and we still kind of scratching our heads and trying to figure out what to do. So in other words, it really comes down to capital allocation. If I have a net and suddenly CEO comes in who says, okay, listen, we have a $10 that sells for $7, let me just give you all the money back. Then I would love to buy that one. But I am yet to see where a CEO says, the CEO comes to the job and says, I'm going to make my job obsolete in 3 months because I'm going to close all the stores and return money to shareholders. That's not that's not, management incentives are not to do that, right? Because their incentives is, to also receive a paycheck, so they can keep for their kids' education. So I don't blame them, but, anyway, all right. Well, thank you guys. I really want to appreciate everybody who joined this call. This is an experiment for us. I never done this, and I was a little bit nervous just because it's a lot easier to talk to a live audience than talk to a computer screen. But I really there were a lot of great questions. I really enjoyed them, and I hope we're gonna do this again, and hopefully this will become as something we do maybe once every a few times a year. So maybe this is a positive chance, maybe that's a new positive change with coronavirus that changes our behavior. And now we do Zoom call a few times a year, and I get to give something back to students. So Brendan, thank you very, very much for doing a great job hosting this call.
My pleasure. Yeah, it was a lot of fun, and I thought we got a lot of awesome questions and a really global audience. So I'm super happy about that. So we look forward to doing this again soon. So thanks, Vitaliy.
Thank you.
Thanks, everybody. Bye.
Bye.
Stay safe.